Welcome to The Explainer. Today we're digging into a really powerful idea from Morgan Housel's The Psychology of Money, and it's this. Everything has a price. Now, that sounds simple, right? But it's especially true when it comes to investing and, well, the price isn't what you think it is. So let's get into it. Okay, let's kick things off with this quote from Jeff Immelt, who used to be the CEO of General Electric. It absolutely nails what we're talking about today. This idea that behind every easy-looking success story, there's a whole mess of hidden struggles and complexities that you just don't see. And you know what? To really see this idea in action, we don't have to look any further than Immelt's own company. We're talking about the dramatic rise and fall of General Electric, a company that was, at one point, the most valuable and admired company on the planet. So back in the early 2000s, GE was, well, they were an absolute titan. By 2004, they were literally the largest company in the world. But then fast forward just over a decade to 2018, and the stock had just completely collapsed. We're talking a spectacular fall from grace that wiped out fortunes and had everyone scratching their heads asking, what on earth just happened? Now, the easy thing to do, blame the CEO. And yeah, Jeff Immelt definitely took a lot of the heat for it. But his whole point was that from the outside looking in, nobody saw the real fight. He was constantly battling investors demanding short-term results, regulators, unions, a massive internal bureaucracy. The job was just so much harder than it ever looked. And this is where it all connects back to investing. You know that advice you always hear? Just buy and hold for the long run. Sounds so easy, doesn't it? But just like running a company like GE, that simple advice comes with a very steep and usually invisible price tag. So what exactly is this price? Here's the key takeaway. It's not paid in dollars and cents. The real currency for success in investing is all emotional. It's that gut-wrenching volatility, that pure fear you feel when the market crashes, the doubt that whispers in your ear, and that nagging regret about what you should have done. That is the real cost of admission. Let me put it this way. Imagine you want to buy a car. You basically have three options, right? 1, you can pay the sticker price. 2, you can look for a cheaper, maybe a used option. Or 3, you could try to steal it, get the reward for free. Now, in the real world, we all know how option 3 is going to end. Not well. Well, in the world of investing, that stealing option looks a little different. It's the attempt to get those juicy, market-beating returns without having to pay the price of volatility. It's trying to be a genius and time the market perfectly, selling at the very top and buying back in at the very bottom. Basically, trying to get the prize without any of the pain. But the big question is, does this whole stealing returns thing actually work? Well, a study from Morningstar looked into exactly this. They analyzed these tactical funds that are specifically designed to dodge market downturns. And the results? They were pretty brutal. During a really volatile period, which is exactly when these funds are supposed to shine, the vast majority of them actually performed worse than a simple, boring buy-and-hold fund. So by trying to avoid the pain, they ended up missing out on the reward. And this just perfectly illustrates the whole idea here. Market volatility, it's not some bug in the system. It's not a risk you're supposed to find a clever way to avoid. It is the price of admission. It's the non-negotiable ticket you have to buy for a chance at getting those meaningful returns. I mean, just look at a legendary success story like Netflix. Between 2002 and 2018, the stock returned over 35,000%. I mean, that is an absolutely staggering, life-changing amount of money. But what was the price you had to pay for that incredible gain? Well, here it is. The price was this. To get that reward, you had to watch your investment trade below its previous peak on 94% of the days. Think about that. For nearly every single day you held it, you were looking at a number that was lower than it had been at some point in the past. That constant feeling of being underwater. That was the price. Non-negotiable. Okay, so if this price is just part of the deal, why do so many people, even really smart people, spend all their time and energy trying to avoid it? Well, it all comes down to a really simple but profound psychological mistake we all make. Think about it. When you buy a car, there's a price tag. It's clear. But with investing, there's no visible price tag on the returns. So when the market suddenly drops and you see your portfolio shrink, it doesn't feel like a price you're paying. It feels like a fine. It feels like you're being punished for doing something wrong. And what's our natural instinct? We do everything we can to avoid getting fined. And this leads us to what is maybe the most important mindset shift in all of investing. You have to understand the difference between a fine and a fee. A fine is a penalty, right? It's for doing something wrong. But a fee? A fee is just the cost of admission. It's what you pay to get something you want. We hate fines and try to avoid them, but we happily pay fees all the time for things we value. The perfect example is Disneyland. A ticket costs a ton of money, right? Over $100. Yet millions of people line up and happily pay it every single year. Why? Because nobody sees it as a fine. They see it as the fee for an amazing day of fun and memories. They know the price going in, and they decide the experience is absolutely worth paying for. And that is exactly how you should think about market volatility. It's the admission fee, it's what you pay to get into the theme park of real long-term growth, the kind of growth that you simply cannot get from keeping your money in cash or safe bonds. It's the price you pay for a shot at a much better outcome. Okay, so this is a really cool mental model, a great way to think about things. But how do we actually put it into practice? How does this make us better investors tomorrow? Well, the goal isn't to try and be a genius who can dodge every bit of volatility. That's a fool's errand. Nobody can do that consistently. The real trick is to internalize this idea, to truly believe that volatility is the fee, and then to convince yourself that the potential reward at the end is worth paying that fee. Now look, this doesn't mean it's going to be a perfectly smooth ride. You can pay the fee and still run into some trouble. As Morgan Housel perfectly puts it, sometimes it rains at Disneyland. But here's the thing. If you're not willing to pay that fee, you don't even get through the front gates. You have absolutely no chance of experiencing any of the magic. So, in the end, it really all boils down to this one simple question. Are you going to view market volatility as a fine that you should avoid at all costs, or are you going to see it for what it is, the admission fee for the opportunity to build real wealth over time? Because how you answer that question, well, that's going to define your entire investing journey.